Good afternoon, everyone. Thank you for joining us for our first webinar of 2021. I think this time last year, we didn't necessarily think that we would have done so many webinars, but I think looking at the situation that we're currently in, looks like we will be doing webinars for a few months more. Just before we kick off, I thought it'd be worth taking just a couple of minutes to have a little think about some of the things that we achieved in 2020. And I was trying to write this earlier today, and it kind of started hitting me that with all of the negativity that we have seen swirling around the world in terms of confirmed cases, confirmed deaths, lockdown, restrictions in social mobility, sometimes it's good to sort of try and look at things through the other lens of what we have actually managed to achieve over the last 6, 9, and for some of us further east, 12 months that we have been now living with this virus. Now, I think if you'd said to us at the start of the year that essentially as a world, we would have been able to come up through the research, production, distribution, and administration of a new vaccine for a brand new disease, that would have had quite a few skeptical responses, but we managed to achieve that and sort of showed what we are able to achieve when we work together. I think both in terms of an adaptability perspective from the corporate angle that we've all migrated to working from home, as hundreds and thousands, if not millions of people have, not just in the UK, Europe, but around the world. So we've had a big show of strength from our adaptability perspective. And I think on the personal level, it goes from being locked up at home, and how many of us have managed to cope with living in sometimes quite restricted environments. And this disease and virus has been something that has infected everybody around the planet in some way, shape, or form, but we have come out of the other end so far and are now starting to see the vaccines administered. One thing which kind of links somewhat to our investment philosophy was this changing in consumption habits. We've been big proponents on both emerging market consumers and this migration to e-commerce. I think pretty much everybody was quite forcibly and quite quickly shifted to some form of e-commerce over the last 9 months. But again, sort of a tick for the adaptability front. People have adapted, changed their consumption habits, changed how they're buying, what they're buying, and continue to survive. And just one other, and I know this is not normally done, a sort of slightly positive marks for governments and central banks for creative thinking. We've seen, given that there was a lot of governments and central banks around the world battling almost real time with the impacts from the virus and trying to come up with different solutions as to how they could try to not just combat the virus itself, but to try and provide sufficient cover for people that were laid off, made redundant, or the other word that's come into everyday use now, which is being furloughed. So I think when I started to look back and thought, although it has been for some a horrible year, for everybody I think an impactful year, there are some small glimmers of positivity that we can pull out from that, which I think reflect well on each and every one of us. If we just sort of take a quick look at the agenda that we have lined up for this evening. So I'll sort of talk briefly about the performance of some of our models and our asset allocation. I think the real focus here is going to be looking at the macroeconomic environment that we're operating within, how we've been deploying in the fixed income and equity space. And then with a lot of these quarterly ones, when we're trying to pull in something that is topical, relevant, interesting, and I think Bitcoin definitely hits all three of those, given some of the price movements we've seen, not just in the last week or two, but ultimately dating back to March, if not earlier. So then we have got a little special look into what's going on in Bitcoin, and sort of there's the list of crew on the right hand side that are going to be talking you through subject by subject. So just before we get on, usual announcements. This is recorded, so we will be sending around a copy of the recording. We do produce this as a slide deck, so we can also send around the slides. And after every topic, we will be stopping just to address any questions that are asked by any of the participants, and there will be an opportunity to circle back at the end just to sort of keep everyone on the same page. But if we kick off with the performance slide, just from my side in terms of a couple of points, our focus is absolute return investing. So we're typically looking at trying to, step one, preserve the value of portfolios in real terms. So trying to beat inflation, and then trying to hit this spread on top depending on the risk profile. So looking back at 2020, we had 8 out of 9 of our models exceeding their target return. I think the only one that didn't on a year-to-date basis was Euro Conservative, which has been quite a tricky place to be investing given the incredibly low yields on euro-denominated debt. So from that perspective, having 8 out of 9 in what has been one of the trickier years to navigate, we've been fairly happy with that, and having all 9 finishing in positive territory, with dollars and sterling finishing fairly positive. Just to sort of have 2 seconds on versus our peer group, we've been in line or exceeding our peer group, but I think one of the important aspects to highlight here, being an absolute return investor, is that we've done so with something of between sort of a third to a half of the volatility that they've been pulling into their portfolios. So I think from my side, whilst the risk adjusted returns are not past performance is no guide to future returns, as the disclaimer goes, we're not going to expect that to be repeatable in 2021 and beyond, especially now that we're starting at much higher valuations. But I think we're happy that we've managed to not pull in a huge amount of risk, still deliver and sort of exceed our target returns, exceed our peer group on many of the models, but doing all of that whilst having a lot less volatility and a lot less risk in the portfolio. Just in terms of our asset allocation and how that's changed just in the fourth quarter, I think if we skip back to the beginning of the year, that equity allocation for a balanced model was sitting at sort of around about 0.5 or 1%. So over the course of that 12-month period, we've gone from 1% to 34%, showing a little bit of the space that we have to operate in. Most of our allocation has historically been in satellites for much of 2020. Our global equities, or our core exposure, was sitting at 0. It was only really in the last 4 or 5 months of the year that we started to ramp that up and started to explore different sort of relative valuation investment opportunities. When we're casting our eyes forward to 2021, that allocation to global equities, I think, is going to be one of the primary drivers of our performance. So I would expect that our allocation to core should, in a normalized world, be about twice of what it is in the satellites, which is sort of the allocation that we're currently running with. Allocations to government bonds are getting increasingly harder given the very, very low yields and potentially the additional volatility that you can add to a portfolio by buying longer dated bonds. So I think from that perspective, we finished 2020 slightly underweight versus what I'd call our sort of more neutral equity allocation of 40%. We've been building in towards the end of the year, but remain underweight as we hit 2021. As there are no questions in the chat, and I don't anticipate them on the performance side, I'm going to pass across to James to talk through some of our macro thoughts and views, which will be relevant as we then start heading across into fixed income, equities, and Bitcoin. So over to you, James.
Great. Thank you very much, Simon. Excuse me. So this is going to be an interesting year. I had hopes at the end of last year that we would have a quiet start to 2021. It has not been a quiet start to 2021, and I do think it's going to be an active year. The good news is that we're getting back to normal, but I think we're going to have a very strong focus on the rates market as being a very binary determinant of what happens and how we should invest. So just very quickly to talk about sort of what's happening with the global economy. So on the left-hand side, this is the Goldman Sachs Global Current Activity Index. So it's an outcast of global economic activity. And I've shown this to you our clients and friends on a number of occasions over the past year or so. And what you can see is that this whipsaw that we had, where everything just suddenly stopped with the lockdowns and then surged as there was this partial unlocking, that whipsaw has more or less worked its way through the system, and we are roughly back into the range of normal a normal pace of economic activity, broadly speaking. And this also makes it a lot easier for people like myself to sort of see a little bit further down the road. So on the right hand side, we have the Citibank corporate. The Citibank Economic Surprise Index, which just shows how much economists and analysts are missing when they're making forecasts. And there were some really big misses. Everybody pretty much completely got the rebound, certainly the timing and the strength, completely wrong. But those forecasts are now back in the normalized range. So this tells me that the global economy is getting back to something that we can call normal or predictable, as much as it could be. The thing that probably has me most concerned in the very, very short term is the degree of consensus in the market. I've been in the financial markets now for about 30 years, and I can't think of very many times when I've seen everybody basically having the same view. And there are a lot of different ways you could measure this. I've chosen two. On the left-hand side, this shows the net speculative length as a percentage of open interest for the ICE dollar basket index. You'll get the same picture if you looked at all the other currency contracts out there. But it shows you that net spec length in the dollar is extremely short. Basically, everybody is bearish dollar for the most part. And I agree, I'm bearish dollar as well. If you look at the right-hand side, you can see the American Association of Individual Investors Bull Bear Index. It's just basically a sentiment indicator as to how professional investors feel, and they're at sort of the upper end of that bullish versus bearish spectrum. So everybody is pretty bulled up, at least in the short term. And again, so am I. So this degree of consensus is probably the most significant near-term risk. And let me just remind everybody what I think this consensus is, because it's one that I largely buy into myself. So the first is that risk assets are going to be supported, in part because of a recovering global economy, and in part because of continued fiscal and monetary support. Everybody seems to agree with that in the short term. This will probably leave many assets in very richly valued, if not bubble territory. And that this is going to continue as long as liquidity remains ample. Everything is already expensive, and I think people recognize this. And this means that generating returns is going to require a willingness to be a bit more nimble, to be able to shift your allocation into relatively cheaper, even if still expensive in absolute terms, assets, and to maybe to time a bit. And then there's one other thing which I think is caught. I don't know if this is consensus. It's certainly sort of at the front of my forehead, but it is something which I think asset allocators are very aware of, which is that bonds are not going to work as an effective hedge in an equity sell-off this year. And this is something I've spoken about in recent client presentations over the last couple of months. Given where bonds are in the valuation matrix right now, they really can't get any. The price of your bonds in your portfolio can't really appreciate meaningfully from here. So if we get an equity sell-off, which I think we're likely to do at different points, you're probably not going to get much insurance from your bond part of your portfolio, and that means that you're at risk of a cascade of selling. So that's what I would call the market consensus at the moment. Now, if we think about how the economic outlook is going to pan out for the next few quarters, 2021 has the potential to be one of the strongest year-over-year performances for economic growth in most of our memory. Certainly, it's going to be a very strong year. Part of that is base effect. Last year was kind of abysmal, so anything will look good relative to last year, and that's going to flatter the year-over-year comparisons. Part of it is also the fact that consumers, households, have not spent the as much money. They've built up a savings buffer to go along with that pent up demand that they have. So once we're unlocked through some combination of vaccines and herd immunity, there's a lot of money sitting there waiting to go rushing into restaurants and trips and all this sort of thing. And that's something that my colleagues Michael and Max are going to talk about in a few more minutes. Now, this enormous stimulus, it comes largely thanks to federal borrowing. So if you look at the right-hand side, this is the rolling 12-month change in debt outstanding in the U.S. in real dollar terms, and you can see that over the past 12 months, state, local, and federal governments have borrowed like never before in the US. It's extraordinary how much they have borrowed and added to their debt. I don't think that's going to unwind anytime in the next 12 months. So in fact, I think with the Biden presidency, you're looking to probably add to that. So this enormous fiscal support is probably going to be largely intact this year. You'll start to see a bit of a drag in 2022 and 2023, but you're going to have this massive amount of private sector spending as people deploy their savings. 2021 is going to look very, very strong in economic growth terms. Now, what's also going to start showing up in 2021 is inflationary pressure. Now, for the past decades, historically, money supply has been a very, very good indicator for inflationary pressures. For the past 10 or 15 years, it has been less effective, and there are a variety of explanations as to why that might be. But one of the explanations that I think makes most sense is that there's been an output gap. So on the right-hand side, this is the difference between actual GDP and potential GDP growth in the US. So that's the output gap. Now, if actual GDP is under potential GDP growth, you don't have that demand pressure on prices. And I think that's really offset whatever influence monetary supply growth would have had, and it's kept the velocity of money really constrained. I don't think that that's going to persist for the next couple of years. The light bars that you see on the right-hand side, those are the U.S. Congressional Budget Office's forecast. So that's the official forecast from the September 2020 long-term budget outlook from the U.S. government. And I think that actually that output gap is even going to converge faster than that. Regardless, what you have on the left side is a demonstration or an illustration that money supply is quite ample and that effectively we're swimming in a pool of gasoline. And on the right-hand side, I'm showing you one of the ways in which that gasoline gets lit, and you start to see some inflationary pressures. Now, it might not be, you might not get a lot of inflationary pressure certainly in the first half of 2021, maybe not until the latter half or even into 2022. But that inflationary pipeline is going to be building up. And that is extremely important because the single most important price of anything, probably ever, but certainly in 2021, is the price of money, the bond market, the yield on US treasuries, the 10-year yield. That's what matters more than anything. Now, it's hard to see on this slide, and I apologize because it looks like there's a graphics issue here. But if you look at the area in between this red line and this blue line, so for example, in 2012 to 2014, that red line is the US 10-year break-even inflation. So that's the market's expectation of what inflation is going to be down the road, and that area is the real interest rate effectively. When the blue line is above, that real interest rate is positive. So that means that you need to earn from your investments in order to beat inflation. When that real interest rate is negative, that means you're being paid just to hold cash or to hold an asset relative to inflation. So what's happened is with the recent collapse in bond yields in mid 2020, you saw and then the subsequent pickup in inflationary expectations, you saw interest rates become sort of substantially negative, and that's fine. I think that's what the Federal Reserve wants. Now, those real interest rates are right now at around -1%. And what's happened most recently is that there's been a pickup in back end yields. So the 10-year government bond is now trading at around 1.18, 1.2%. So it's picked up quite substantially. That's mostly matched the increase in inflationary expectations, which means that that negative real interest rate is sort of stuck at -1%. And I think that's what the Fed wants it to do. You can see on the right-hand chart, that's the 2s to 10s yield curve. So that shows that, that the Fed is continuing to sit on the front end of the yield curve. It is not moving. But the back end is picking up with inflationary expectations. So the real key question here is what happens next? I'm confident that the Fed is not going to allow the back end of the yield curve is not going to allow government borrowing costs to accelerate much further, because the Federal Reserve is extremely aware of how that will damage the ability of the federal government to maintain its debt. Right now, the Japanese government, in a similar kind of situation, is actually a net receiver on its net interest payments. So in other words, it has so much negative debt, negative yielding debt out there that people pay the Japanese government in order to borrow, in order for the Japanese government to borrow. In the US, net interest payments are close to historic lows. Now, if the yield in the 10-year picks up much further than this, those net interest payments will explode. So what I'm waiting for right now is for the Federal Reserve to look at these two charts that I'm showing you here and to say, yep, negative real interest rates, I'm happy with that. Yep, yield curves picked up. That allows banks to survive. That allows a little bit of economic activity to get primed. But I'm not going to let it go any further than that, because I can't let the governments find their net interest burden get out of control. So right now, today, we are at a pretty important point, which is this is where the Fed says there and not much further on the back end. And that's what I'm very focused on right now. If the Fed loses control of that narrative, then you're going to have a very, very big problem in financial markets, and everything's going to come down. If the Fed maintains control of that narrative, which I think they will, I think that these markets just have further room to rise. Now, this pressure on the back end of the yield curve, this is being driven by market expectations for better growth, better inflation, et cetera, and so forth. The copper-gold ratio has historically been a very effective sort of comparison or proxy for the US 10-year yield. And copper to gold is really a way of measuring sort of risk on versus risk off, or it's way of measuring the growth outlook for the real economy. So when copper outperforms, that's usually pretty positive for risk assets. And right now, that copper gold ratio is telling you that that the 10 years probably about 100 basis points too low as far as the yield. And that's probably thanks to the Fed already. Now, one part of that story with copper and gold might be the gold price. So gold has tracked the real yield extremely tightly over the past 15 years or so. And with that real yield now at about -1%, and it looks like it's not moving anymore, that engine, which drives gold, has probably paused for now. That engine's been switched off. Now, gold has other engines, and the other engine in particular that I like is the dollar. So sometimes it's the real interest rate that's driving gold, and sometimes that regime switches, and you've got the dollar driving gold. But right now, I think that real interest rate engine is probably going to the side, and the dollar is likely to take over as the prime driver. I mentioned at the beginning of this presentation that the markets are very consensus right now that everybody's bearish dollar. I am bearish dollar. I think that the dollar is going to continue to go down. Nothing goes in a straight line, but I do think it's going to weaken. And I think that's going to help to push gold higher. So that's my view on gold, and that is going to help to. So that's my view on gold. And then finally, last but not least, I'm going to leave you with just a very quick thought on Bitcoin. My colleague Paul is going to be speaking at a little bit more length later on in the presentation to help us all get a better understanding as to what the Bitcoin or what crypto asset markets look like, how they're structured. One of the things that I've been looking into this a bit. One of the things that I've just sort of been struck by is that as with any new market, people are still trying to understand what Bitcoin is, what it does, what it doesn't do, how to value it, how to understand it. In a lot of ways, this reminds me of what I understand the FX markets to have been in the mid 1970s. So after the currency markets were sort of unleashed, and we no longer had the fixed exchange regime after Bretton Woods, people were still trying to figure out how to value it. So in the Bitcoin market, we're trying to figure out how to value it. And one of the things which makes me feel like this is a market which is starting to mature is that over the past 4 years, it's shown a fairly strong correlation to the US dollar. So the dark blue line is Bitcoin in log terms on the left-hand scale. The sort of greenish line is the US trade-weighted dollar on the right-hand side. And you can see then 2017 through 19, Bitcoin really traded in sync with the dollar. There was a bit of a divergence in 2019, but then in 2020, Bitcoin appreciated with the dollar weakening. And that to me tells me that you're starting to see a market where traders are starting to arbitrage and are starting to identify how to buy and sell an asset relative to underlying fundamentals. I don't know that Bitcoin's fundamentals are going to remain tightly linked to the dollar. I think there's still a lot of debate as to what those fundamental drivers are or should be. But this to me is a sign of a maturing asset class. And I think this is something that Paul is going to be speaking about in a few more minutes. I'm very aware that, as I always do, I've run a little bit over my allotted time. I don't see that there are any questions at the moment, but feel free to ask any questions, and we can address them later on in the presentation. But with that, what I'd like to do now is to move it over to my colleagues Adrian and Jeff, and they can talk a little bit more about the fixed income story. Adrian, over to you.
Okay, thank you, James. You've actually touched on quite a lot of the points I was looking to make, talking about inflation, but also why inflation and this fiscal stimulus that we're going to be seeing in the US is a bad combination for the bond market. When I look at the bond markets this year, what I'm finding is that the risk-reward scenario is very bad. There's very little opportunity for me to make money unless I trade some of the volatility that we're seeing. So if we look here, last year, we've seen that the Fed actually moved to average inflation targeting. So we can see the inflation expectations very above 2%, but the Fed will not be moving much. The market is already pricing in a pickup in inflation. And this is why the back end of the US yield curve has moved up. But the other factor behind this is also the supply expectations for this year. When we look at the supply, we expect the US market to see almost 2 trillion of excess supply that needs to be absorbed by investors, whether foreign or domestic. We're not talking about the Fed here, we're talking about domestic. So this is an upward pressure on yields. So these two things are big factors. And part of the move we saw where yields moved up by almost 20 basis points last week was also has the market started pricing in potentially more than 2 trillion coming in because of the Democrats' control of the Senate now. Now, what we're seeing in the bond market is going to be a sort of fight, a push-pull between these factors, which I think are the worst possible combination for it, especially when we have a low starting yield level versus the mixed and variable economic data that could be coming out due to lockdowns, stopping. We're seeing this happening in Europe especially. And as James has mentioned, we expect that the central banks will keep the policies accommodative, and there is a huge demand for yield still. People like income. And unfortunately, no matter how little it is, They still need it. There's lots of mandates which are purely fixed income. As James has mentioned, I'd also like to point out that it's not going to happen in Q1, but sometime this year, the Fed is cognizant of the effect of rising yields on the equity markets, on the impression of the economy overall. Therefore, they will probably move to support yield curves. Remember, they've gone through this before. They've actually seen how the market reacts to them indicating tapering in the past. They have to be very slow and cautious with it. They've indicated they will be. So overall, for us in positioning in government bonds, we're underweight just because of the low starting yield levels. We're going to be seeing volatility. So what we tend to do is trade around this by looking to add to government bond positions or credit positions, especially as the market sells off, and we look to buy more. What I did was some work on the expected ranges for this year, and also for what this means for basically the benchmark bonds in the US treasuries and also in Germany, to get a feel for what could I possibly make in the bond markets this year if my scenario predictions are correct, my trading ranges for this year. So this is the table on the right-hand side, where I've shown the prices as of the 4th of January and the yield level, and then taking the top and bottom end of my ranges that we see on the left-hand side, what is the potential price change and the carry that I'm earning over this period. So if I'm only buying and holding US Treasuries for 2021, where I expect a gradual increase in yields, you know what? Even if it's at the bottom end of my range, my total return for the year is still going to be negative because of the impact of the price movement alone. In Europe, in Q1, I think it's unlikely we're going to go to 80 basis points now, but even if we go to it, it's still going to be negative return for the quarter. So I'm going to have to trade around this, continue to be underweight and try to pick up at the right times, and then basically sell back to the market when it tightens in a little bit. If I like in Germany, which is, proxy for Europe for me, I'm really struggling to see how I can make any decent returns in the fixed income markets. The low yields, negative yields are not helping me. So I've got a negative price action for the year potentially, mainly led by the US moving higher, but also I have negative yields to contend with. So I'm losing on both sides of the equation here. So how are we going to sort of position ourselves going forwards? We have to, if we move on to the next slide, please. We have to have a look at where people were positioning themselves last year. And what we can see is that last year, looking at just purely the ETF flows, in the US, investors really didn't put much money to work in, new money into the government bond markets. Or, high yield to a degree, but not as much. But where they did put their money in was IG. And this is why we've seen sort of a compression. IG was very well supported last year. This year, you have to be more selective and probably more lower down the rating curve. But the area which we think is going to be more active is going to be in the high yields, where we're still able to see yields of 3 to 4% as well. So my colleague Jeff will talk more about where you should be positioning yourself in credit, but upon any sell-off, this is where I would urge investors to be adding to their allocations. I'll hand over here to Jeff, who's going to be talking about the high yield market now.
Well, thanks, Adrian. And just turn to the next slide then. In our search for yield, even in the now not so appropriately named high yield asset class, high single-digit percentage yield, it's becoming really hard to come by. And part of that is actually due to call constraints. To serve as a reminder, we just talk about call constraints. The call option embedded in most high-yield bonds, it gives the issuer the right to buy back the bond at a fixed call price from a series of call dates, and it allows them to refinance the debt with a lower coupon. If the bond investor believes the issuer is likely to buy the bond back, then it makes absolutely no sense for the investors to continue buying that bond at a bond price above the call price. So looking at the $1.4 trillion of total US high yield bonds that are outstanding in the market by year of maturity, it would actually appear that most of the bonds are due to mature somewhere between 2025 and 2028. But when you actually look at the same bonds based on their call schedule, so that's the chart directly below the maturity schedule, in reality, the bonds are actually trading to much earlier call dates between 2021 and 2025. And the effective holding period is thus shorter for investors, and the potential return for investors is also limited. And in a market where high yield bonds are on average trading at a cash price of 105 cents on the dollar, you've got 72% of bonds that are callable, which are now trading above its next call price, and is what we deem as unattractive. And this is most pronounced in the double B rating tier bucket, which, however, does face significantly lower default risk compared to the beginning of last year. And looking at many of our portfolios high yield positions, Lafarge, Holcim, Clarius, Tenet Healthcare, most of those bonds are now trading above its call price, and that's why we're reticent to increase risk in those existing positions, which are expensive, and where the upside price potential clearly has a cap on it. So if we move on to how we've been digging deeper to find value opportunities, because they are still out there in a market where there's still a dispersion of returns. Well, we've been focusing on looking for bonds that don't have these call constraints. And one obvious area is fallen angel bonds. Now, these are bonds that began life as investment grade, but have since been downgraded to junk status. They have lighter covenant packages, no embedded call options, and we saw a wave of these fallen angel bonds enter the high yield index last year amidst the period of sharp and deep economic contraction. Looking at this chart on the left, I've ranked from left to right fallen angel issuers with the earliest casualties on the left-hand side of the chart and the more recent fallen angel downgrades towards the right. You can actually see that the excess returns have averaged around 20% for investors who bought these issuers at the time that they were downgraded. And we still see, despite the stellar 20% returns, still see excess return potential in select companies. And one fallen angel that we see as that we still see as a dislocation opportunity is Ford's automotive bonds. We like Ford. We think the automakers are well positioned for a US economic rebound. And Ford in particular, it's got a strong competitive edge with its product mix because it now focuses on selling pickup trucks and SUVs in the US market. And even though Ford's, when looking at its profitability margins, it's come across as a laggard, but we think the restructuring plans that it has in place, which are beginning to bear fruit, still have legs to run further. And I think there's scope for Ford to catch up with its competitors now that it's deploying serious capital into the space of electric vehicle powertrains. And there's plenty of scope for us to see further spread compression in its bonds. And I think this is best illustrated with the chart that I have on the right-hand side, where Ford's bonds, which are, again, I'll remind, are non-callable, trade at a discount to the broader double B index, and the value is most pronounced beyond the 5-year point of the curve. And compounded by Ford's improving fundamental story, I think the scarcity of non-callable bonds, particularly longer dated non-callable bonds, will help to drive Ford's bonds higher and help us to enhance the overall portfolio the overall yields in our portfolio. So with that, I'm going to turn this back to Simon.
I'd say thanks, Jeff. Always happy to have it flashed back over to me. Before we have, so we've got Misha joining us and Max joining us to talk through some of the equity ideas. So I'm just going to hand straight over to Michael, who's our equities portfolio manager. Over to you, Michel.
Thank you. Good afternoon, everyone. Start of the year webinar is a good time for us just to recap on our equity strategy and show how it is reflected into our current equity positioning. So we expect economy reopening will be key investment theme for 2021 and see key channels for this, pent-up demand for traveling on consumer side, and also pent-up demand for capital expenditures on a corporate side. And finally, we will touch upon recent events dealing with Chinese IT stocks, and we'll speak about risk of them being delisted from the US trading venues, and also about antitrust investigation against key e-commerce players in China. Let's start with a recap on our equity strategy. At the moment, we've got around 85% out of neutral equity share invested, and this should be scaled accordingly for different investment mandates. And as a reminder, we are following core and satellites approach. You can see our core in the middle of this slide. And for core, we are ordinarily using ETFs to reflect our midterm tactical equity calls. We've got a 22% exposure to pure market beta via MSCI World Tracking ETF. And also we've got 5 style ETF, which reflect our tactical midterm views. We've got exposure to global materials, value, small and mid caps, international stocks, and also to UK stocks. For satellites, we ordinarily using single stocks just to get exposure to long-term investment themes, such investment themes as emerging market consumer, video games, and online life. On satellite side, at the moment, we'll also get single stocks, which should benefit from economy reopening later in 2021, which we think will be key theme and should underlie stock selection. Moving further to resumption in consumption. So I can show you the same chart which James already mentioned, but it not only for US, but also for Germany and for France, and situation very similar for many developed markets because of consumers in these countries been given quite generous support from their governments, and at the same time they been locked and not able to use this money in many traditional ways of consumer spendings. And we're thinking that this will be realized further this year once it will be safe to travel, once it will be possible to travel. Moving further, I would say that a vaccine will be key enabler for this, for unlocking this pent-up demand. You can see on the left-hand side of this slide that vaccination rates already managed to reach quite substantial levels in certain countries, and we're thinking that with help of seasonal factor that traveling will be eventually available for consumers in the coming months. This large pent-up demand for holiday entertainment in 2021 should in turn will drive tourist spending and air traffic. That is why we have in our portfolio stocks of Delta, which we think got the strongest balance sheet in the industry, and we got stocks of this company. We're also thinking that a rise in air traffic should boost demand for oil, and that is why we got certain global oil producers in our portfolios because we expect a rise in oil prices later this year. Speaking about one more way of economy reopening, we expect that the CapEx cycle will be a key component for the economic recovery in 2021. So corporate executives have been more focused on preserving corporate balance sheets, just getting sufficient liquidity to address economic uncertainty. But now, because of a lot of capital expenditures were canceled or postponed, corporation just faced underinvestment into fixed assets, and we expect that this pent-up demand for capex will be materialized later in 2021. And actually, you can see that according to CEO economic outlook on the left-hand chart, it's already improved, and it historically correlates with global capital expenditures. On the right-hand side of this slide, you can see that these expenditures should be coming from such sectors as oil and gas, utilities, and autos. That is why we expect a rise in demand for machinery, for chemicals, for commodities, and that is why rising global capital expenditures should underlie our positive view on materials and industrials. As I already mentioned, we're using style ETFs to get exposure to this investment theme, and we using our core of our equity portfolios to get exposure to this theme. On this, let me ask my colleague Maksat join me and speak more about Chinese IT companies.
Thank you, Misha. Good afternoon, everyone. First of all, I would like to talk to you about Chinese stocks delisting from the US and focus on 3 companies that we hold in our portfolios. So as a continuation of tensions between US and China, US Department of the Treasury published a list of Chinese companies that it deems as having connections to Chinese military last week. And this list includes companies both private and publicly listed, and those companies fall across different sectors, including telecommunications, industrials, technology, and energy. However, what you can see, or what you rather cannot see in this list, are JD.com, Tencent, and Alibaba. And this came as a major relief for investors, and the share prices of these companies appreciated last Friday on the back of this news. However, if we look more closely at these companies, we see the risk for them is limited, as first of all, these are big players in their respective sectors, and very well established players with enough capital and earnings to sustain their operations. And then second, in terms of the fundamental exposure to the US or revenue exposure, it's negligible. So for JD.com, it's 0% as the company operates in China only. For Tencent, it stands around 1 or 2%. This comes within the games business. And Alibaba as well has a very limited exposure of less than 2%. So as a sum up of as a risk for these 3 companies, again, we see it as very limited. And also these companies are dual listed in Hong Kong as well. Now, this is not the only story that has been happening recently. Actually, on the other side of the Pacific, regulations have been tightening, and Alibaba was in the spotlight over the last couple of months. So the story began with the delay of Ant Group IPO, which is a sister company of Alibaba and which operates primarily in the payments and credit business. Then the second leg-down came in December when the government started an anti-competitive investigation into Alibaba with focus mainly on the exclusivity agreements. So under these exclusivity agreements, merchants are forced to choose a sole platform for their operations. Now, to provide more clarity, I would like to discuss 2 previous cases which happened in online games and education industries previously. So first, with online games, Tencent was the main company, and back in March 2018, the government froze the approval of game monetization licenses, or banhao as they are known in China. And this happened to address public concerns around violence and gambling and in some games. So on the back of this news, Tencent share price fell approximately 30% over the course of several months. However, as the process was coming to an end, with regulators increasingly gaining clarity of the fast-growing gaming industry, the review of the licenses restarted in December 2018. And this allowed to Tencent continue its operations within the games business and the share price to continue its growth upwards. The second case happened same year within the education space, and this was probably a more severe case for the companies involved, as both TAL Education and New Oriental Education operate exclusively within the education industry, whereas for Tencent, games is only one of their segments or one of their revenue streams. So in June 2018, the government started a comprehensive investigation on after-school training, and they published guidance with detailed requirements on multiple fronts, including training time, training content, institutions license, standards regarding facilities, teachers' qualifications, and other. This guidance was followed by strictly executing rectifications, which nearly halved the share prices of both companies. However, in December 2018, as the Ministry of Education announced that the rectification was largely complete, and despite the fact that the overall tone of the guidance remained unchanged, this was a catalyst for the share prices to fully recover and continue their growth. So now speaking about Alibaba, and if history is any lesson, we see the risk for the company and its operations is limited, and potential outcomes may include fines. Actually, this is likely, and regulators were talking about 10% of total annual revenue as a maximum threshold. However, we think it's unlikely. It's probably will come around 2 or 3%, but considering the cash balances of Alibaba, it can well afford to pay this. And then actually the first fine already came just recently. This was in relation to pricing around Singles Day sales in November. And so Alibaba, JD, Vipshop, and Pinduoduo were fined by 500,000 renminbi, but it's a very small amount for these companies. And then if you look at the valuation of Alibaba, it currently trades at a very large discount on the forward P basis against its peers, and we think the concerns are overblown, and the stock looks attractive at this point. So to sum up, the key overhang is uncertainty, and when this uncertainty goes away with the final decision being announced, we think the share price should continue appreciating again. And on this, I would like to pass back to Simon.
Thanks, Max. I see Paul on queue has joined. Just to sort of give a couple of quick words before we set Paul off. We've been sort of tracking and exploring a little bit more into the, from my perspective, slightly bizarre world of cryptocurrency. Paul luckily has a much larger knowledge base. It's something that we have clients that are already holding, have been trading, have been looking at some of the ETFs that hold Bitcoin and other cryptocurrencies. Given some of the price movements that we've seen over the last 9 months, and I said sort of the craziness that we've seen in the first couple of weeks, our timing has actually been fairly apt. Paul's challenge has been trying to sum up in a sort of a short period of time what's been happening in Bitcoin, and obviously Bitcoin is a sort of the tip of the cryptocurrency iceberg. We are, open to getting some questions. We know that there is quite a lot of interest in this area. We've seen it from some of the ways that institutional investors have started slowly exploring the world of cryptocurrency as well. So I will pass over to Paul, and Paul, let's see what you can do.
Thank you, Simon. So I've got 8 minutes to cover this, I've been told. So I've tried to condense what I think is quite a large subject into a relatively small amount of time. So what we're going to cover today is some of the, what Bitcoin is, I suppose, and how it's being used as an asset. We're also going to cover some of the change in attitude we saw towards this asset, some of the investment options, and just a quick note about what we're not going to cover is, I suppose, some of the other innovations that have happened after Bitcoin, all working on fairly similar technology bases, but hopefully we'll be able to have those conversations in the future. If we could have the first slide, please. So what is Bitcoin? I'm not going to go too much into the technical details here. We could summarize it as a decentralized electronic peer-to-peer cash system. It's also acting as a store of value. Now, there's lots of good online content about how it all works. Again, I'm going to brush over that and fixate more on why does it matter. So Bitcoin really is the first time where you could send somebody something electronic without a counterparty. And by that, I mean, you can, the sender can send something which the receiver knows they've received. There's no zero trust involved. It can be verified at both ends. And very importantly, the receiver knows that the sender no longer has access to this asset. So clearly that's very important when we talk about things of value. If we compare it to cash, now cash person to person is easy enough. As soon as I can hand you paper money and you know that I no longer have it. Now, if we try and do that electronically, we have to use counterparties, we have to use banks, we have to use payment networks. If you're talking about e-commerce, there's actually maybe 4 or 5 counterparties every time you make a transaction online. Now, the key innovation here with Bitcoin is that, to coin a phrase, Bitcoin fixes this. It allows a pure peer-to-peer trustless transaction. There's also some other interesting factors of it. It's a very resilient architecture from a technical point of view. It's not controlled by any one nation or company, and it's a completely open network. And I think the last thing to point out here is this is the first practical application, which has spawned many others, and the whole space is exploding and is becoming incredibly interesting. But Bitcoin really is the 0 to 1 moment, as Peter Thiel would define it as. You've got a lot more in the one-to-many moments, but most of them are trying to do different things. Bitcoin is definitely the most interesting digital asset, and I believe it will remain that way for a while. Next slide, please. So here's I think everyone now is familiar with the narrative of Bitcoin as digital gold. I've tried to draw some comparisons here. So it's in market cap terms, it's about 6% of gold, and clearly, it's got a lot less history behind it. It's also a lot more volatile. If anyone's been following the markets over the last few days, it's been interesting trying to put a slide up saying the market cap of Bitcoin, for example, when it can change 25% in a day. But it's definitely a volatile asset compared to gold. Gold is trusted, it's stable. If you want a store of value that's stood the test of time, it's clearly an appropriate one. In this sense, Bitcoin's more of a startup. It isn't the market's still trying to find out what it is, what it isn't, what it's good for, and where other assets are possibly better. But I think some of the characteristics of Bitcoin do make it very relevant for the kind of current world. Like I said, it's highly transportable. You can transfer it anywhere and to anyone in the network. So that's in the world and beyond in approximately 30 minutes. It's fair to say it's got limited other utility compared to something like gold. But then I think it's also fair to say that gold's primary valuation comes from as a store of value, more than its use in, say, jewelry and manufacturing. And again, going down to the bottom, I mean, it very, very much on the change side with Bitcoin is the regulations, the law, and the taxation side of it. Now that's rapidly changing in the Bitcoin world, and again in gold, there could be a surprise to the regulation of gold, but it's probably unlikely at this stage. And with that, I think we'll move on to the next slide. So this is a kind of a summary of what happened in 2020 in relation to Bitcoin, mapped clearly onto the price itself. Now, the first half of the year was dominated by the pandemic. So it was dominated by the COVID story. Bitcoin reacted as, I suppose, a risk-on asset with a big sell-off when the markets crash with everything else. But broadly, in line with the S&P, in line with gold. So lots of cash got taken off the table, and while people tried to work this all out. Now we post the crash, I think there are various things that started to play into the narrative of Bitcoin. One thing I'd like to highlight is, the Federal Reserve attitude when they've come out saying that they've got essentially an infinite amount of cash to respond to the pandemic. Now, this plays into the hands of the Bitcoin narrative in a way, where you've got an asset with a fixed supply that can't be artificially, well, we can't print more than the designated amount by the algorithm. So it's a more known asset in that sense. There can't be a flood of it. There can't be the inflation rate is known and it's algorithmically defined. On the supply side, there was a key event, which is the 2020 halving. Now, a new block in the Bitcoin blockchain gets mined about every 10 minutes, and the miner who produces that receives a reward. Now, up until this started out at 50 in the early days of Bitcoin, and then approximately every 4 years it halves. Now, in May 2020 was the last halving, and that dropped the reward from 12.5 to 6.25 Bitcoin for every new block. Now, what this means is the new supply rate drops to about 2% per annum. Now, we also started to see, so that's kind of like, I suppose, the new supply side of things. Now we move on to the demand side, and in comparison to the Bitcoin boom in 2017, 2020 saw a lot more serious money and institutional buy-in. Starts off with Paul Tudor Jones, who announced his fund as invested in Bitcoin and compared it to gold, and basically described it as I think his words were, if I have to choose one, then I'd probably choose Bitcoin. Now, that was very interesting because it's kind of like an established investor, a serious player. It shows the kind of nature of the people coming into the space. Stanley Druckerman has followed, Bill Miller. There's been a Brazilian billionaire, I forget the name of, but again, he's also come out in support of Bitcoin as an inflation hedge and a store of value. Interestingly, then we move on to an event in August where a previously unrelated firm, it's a business intelligence firm, it's listed in the US called MicroStrategy. Now, they were sitting on a supply of cash. They didn't know what to, they didn't have any investment targets. They clearly didn't have a lot to spend it on within their business. And they were looking around for what they could use as a store of value, and they settled on Bitcoin. Now, why this is interesting is because this is a multi-billion-dollar firm using Bitcoin as a reserve asset. And again, the MicroStrategy were not a crypto firm. They don't have any stake in they don't provide any kind of Bitcoin-related services. They were just using it as a reserve asset. Since then, they've actually done 2 more buys. So in total, in 2020, they bought more than $1 billion worth of Bitcoin. You've also started to see more support from vendor side. So Square already, prior to 2020, already have added BTC in their Cash App application. PayPal in October also released it to all US users. Again, you're kind of seeing more and more adoption. And the other interesting thing with both PayPal and Square is that they became key drivers for demand as well. So under certain, according to some analysis, PayPal and Square alone account for 110% of the new supply coming into the Bitcoin market. So that's a key driver of demand. And again, towards the end of the year, we start to see the price rise. I've marked a Mass Mutual on there as well because it's interesting, and there's a very different institution, an insurer getting involved in an asset like Bitcoin. So hopefully, what I'm trying to show here is that the market participants in Bitcoin have changed dramatically from what we saw in 2017. I think it's fair to say that 2017 was a retail-driven price boom. 2020 appears to be a lot more institutional demand. People are using the asset for different things. Yes, people are still trying to discover, price and valuation. But like I said, it's a very different picture to what we've seen before. And hopefully this explains some of the supply and demand characteristics. towards the end of the year, we saw a new all-time high, which was, around 20,000. Previously saw in 2017. I think we peaked about 41 and 40, about 41,500, I believe, in the new year. There's been a bit of a correction over the last few days. I say a bit of a correction. That's a Bitcoin language. I think it's about 25% drop, which might terrify some people. But for the people who are used to these markets, that kind of like comes with the territory. And with that, I'll move on to some of the investment opportunities, please. Now, I haven't covered the obvious, which is, buying Bitcoin as an asset. Yes, it's possible to do that. There are benefits of handling the assets in that way. There are also some risks and some negatives that go with it as well. So I'm going to cover more the regulated kind of capital market side here. So we've got futures and options on the CME and backed. We've got it's possible to take a position, an indirect position through companies, like I said, like MicroStrategy is the obvious one. You've also got Square in the US, who not only offer Bitcoin to their users, they also hold, I believe it was $50 million worth as a reserve asset. And Mode in the UK, who are a bit like Square, they're a listed firm, and they both offer it as a service and also hold it as a reserve asset. And then we've got, like I said, PayPal and Square, who are offering services to the market. Very interestingly, there are going to be digital asset native firms who are coming to market. So you've got Galaxy Digital and Mode on the market right now. Backed, who are a digital asset futures exchange. They've just gone public via a SPAC. So they're also an option here. Coinbase are a massive one of the bigger players in the crypto, in the pure digital asset market. They plan to IPO this year. That will probably see others follow. There's also increasingly there's ETP coverage, so things that are tracking the price of Bitcoin. And I've separated from the ETP side, but you've got the Grayscale Trust. So the Grayscale Trust is a massive player now in the Bitcoin space. It's seen a huge amount of volume added to it over in the last year. A huge amount of inflows came into it. It's acted as a key driver for demand as well. Again, going to the supply and demand characteristics and the new supply, especially the Grayscale Trust was at points was consuming almost the entire new supply of Bitcoin into the market just on its own. It's obviously that's in line with when you add to it PayPal and Square, then you're starting to see a really interesting narrative here. One thing I would say about the Grayscale Trust is it tends to trade at a premium to the assets they actually have under management, which is just something to be aware of if you're interested. And so with that, I think I will conclude. Hopefully this was interesting to people. Like I said, we would very much like to continue this conversation. So I think if anyone wants to reach out to me individually, I'm more than happy to have conversations individually with people. But we will also be producing more content where hopefully we'll go into things in a lot deeper detail than we have today.
Paul, unfortunately, you don't get off the hook that quickly because there are two questions that have come in. The first one, which we can hopefully deal with fairly quickly, is what is the biggest risk I should think of when investing in Bitcoin or cryptocurrency?
The biggest risk is that you can lose all your money. So that's I think that we are all still collectively trying to work out what these things do. What I'd say is that as the market matures, and you get more and more institutional players in here, and the volumes increases, and actually the market cap of these things increase as well. What you're seeing is that it's less likely you're going to lose all your money, but clearly it's still a risk. Lots of people see this as an antidote to the money printing that's going on in the world. So clearly a risk here is that central banks change policies, the money supply reduces. Maybe we even start paying back some of the debt that we've taken out. That would potentially harm the narrative behind Bitcoin. There's regulations, which it's fair to say Bitcoin is a largely unregulated asset. That's changing, and for the most part, regulators have been reasonably friendly, but that's kind of a key risk here, which could damage price. And then there's also, I suppose, risk within the cryptocurrency market. So there's a stable coin known as Tether. That there's lots of rumors about Tether, about whether it really does have the assets to back up what it does, what it says it is, which is a coin that's basically worth $1. So it should be $1 in the bank for every token that exists. Now, there's a lot of interest in Tether from a US regulatory point of view. You know, that could be very interesting as well. So there clearly are key risks to this market, and I think more, and then the other side of it is just the pure speculative side. So yes, there was increased demand for it, obviously, which is one of the main reasons why the price rose, and a reduced supply. These things do tend to be very spiky, as you've seen the Bitcoin price probably, you know, over time. It's akin to the Gartner hype cycle, if anyone's seen that, where it's kind of like, you know, in most technology, with most new technologies, you kind of get a boom and then a more gradual decline back to some kind of like consensus. Now, the Bitcoin price has done this repeatedly. The question is where we are in the current boom. It's hard to say, but so that's probably your key risks.
Thank you. And the last question, which is amusing because it's something that we were discussing earlier. The very existence of Ripple XRP is at risk due to action taken by the SEC. Surely any crypto is susceptible to this risk as well.
So any crypto is susceptible to regulatory risk. The SEC have declared that Bitcoin is not a security. They've also declared that Ethereum is not a security. So with those two cryptocurrencies, you at least remove that regulatory risk. But yes, I mean, the regulators could change their attitude to Bitcoin. It would be incredibly hard for regulators or even a nation state to completely stop the use of a very determined Bitcoin user if they have an internet connection. But what they could, what they could do is start throwing people in jail if they handle Bitcoin, and more likely they could put pressure on the kind of fiat to Bitcoin transfer mechanisms, where clearly, you know, they regulate the banks, they regulate the payment providers. So that would probably be where they could put pressure. But explicitly with the SEC, then I don't believe that would be much of a risk, because they've already said that it's, in their view, it's not a security.
Perfect, thank you. I think we're in slightly different worlds where a year's work for most of the investment team is a day's price movement, or maybe even an hour for people sitting in the cryptocurrency. I was going to say that hopefully has given a little bit of an insight into people and peeled back some of the sort of confusing moves and headlines that we have seen. Had a couple of questions. I think there's quite a few pieces of follow-up that we have on this. And I think one of the interesting potential ways of investing that you kind of highlighted is some of the capital markets routes. So that's something that we can explore further as well. Are there any other questions that people have for Paul whilst he is here? If not, I think you can finally manage to get off the hook. Oh no, you've just had one more come in. Just to read out in case anyone can't see, while information on each digital currency transaction is recorded on the blockchain, this data is not directly linked to names, physical addresses, or other identifying information. Does this make digital currencies anonymous to a certain degree and complicates efforts by law enforcement agencies to identify individual transactions and link them to users?
Okay, so I guess that's a question for me. So I'm going to talk just about Bitcoin. There are different cryptocurrencies that have different characteristics. Some aim to be private, commonly known as privacy coins. So if we just cover Bitcoin for the purpose of this, what I would say is it's pseudonymous. It's not 100% anonymous, and I think that was a key mistake that some of the early adopters of Bitcoin made when they used it for slightly illicit purposes, because they didn't realize just how traceable it is. So on the positive side, if you are concerned about your privacy, it's difficult to link a wallet address, which is a string of characters, to a person or you know, an entity, and or even a nation and a location. But what you do have with every single transaction that's ever been recorded on a public ledger, the blockchain, is that, you know, anyone with an internet connection can see all of the transactions that have ever occurred. So the remaining thing to do is, for law enforcement, is to link individuals to wallet addresses. Now, this this can be done. There are companies that specialize in linking wallet addresses to entities and to an extent judge their risk. So if we think about something like, say, a terrorist organization which has raised money via Bitcoin, if they publish the address which they would like the Bitcoin funds to be sent to, that's fairly trivial for these firms to then track that, and say pretty much everything that goes into that address, and then most of the things that go out of that address are tainted. So there are analytics tools which the industry uses to look for kind of tainted coins, to look for high risk transactions. So it's important to realize that it's pseudonymous, not anonymous. And like I said, there are ways that we can enforce AML, which is the reason why you now have a big financial services firms offering Bitcoin and other cryptocurrencies. So hopefully that answers the question.
It did. Unfortunately, just as you were answering that, another one came in. We'll make this our last question. Just I'm conscious that people might have other things to do this evening, given that most of us are locked down at home. Question is, whilst the potential returns are enormous, there seem to be more negatives stacked against investing in crypto. Surely an investor is better off sticking to small cap stocks or using leverage if they require a bit of spice in their portfolios.
I mean, I think an investor's portfolio really should reflect what their aims are. So, I mean, it's kind of like a question for the individual. I think what we're seeing more is that people are looking at assets like Bitcoin as an option. Whether they're right for you or not is really a different question. It's on the one hand, you've got asymmetric returns, right? So it could go to 1 million, but on the other hand, you could lose all your money, which is not true of most other kind of like store of value assets. Let's face it, gold is very unlikely to go to zero. I think the other thing I would say here is that when we look at the investment options for people that see value in the theme and growth in the space, but don't necessarily see Bitcoin as an asset, well, you could potentially look at some of the companies that add services, either provide services to the market or are engaged in it in other ways. So my examples there are companies like Coinbase, companies like PayPal, companies like Square. These are ways to actually get indirect exposure to this if you see this as an area of growth, but you're not overly comfortable with Bitcoin as an individual asset. And like I touched on at the start, is that all the other cryptocurrencies we haven't really covered today, but they're all very, very different. Bitcoin's the winner in the cryptocurrency store of value world. It only really these days I'd argue it's actually transcended crypto, the crypto space, and is competing more directly with gold with more traditional assets for investors' money. There is a slew of other cryptocurrencies out there that all aim to do slightly different things. But there's probably a lot more. There's potentially more reward with them, but there's also a lot more risk with them as well. So hopefully that answers the question.
Paul, if I could just interject, if you just take a moment and breathe for a second. So as somebody who thinks a lot about asset allocation, about whether something deserves to be an investment or not, I can say that Bitcoin or a crypto asset has as much a reason to be in an investor's portfolio as gold. If you think gold, which is a non-coupon bearing, non-dividend earning, non-revenue generating asset, has a role in an asset allocation, then you then would look at Bitcoin and say, okay, so what are the relative pros or cons? And that doesn't mean that I think you should have gold, or it doesn't mean that I think you should have Bitcoin over gold. But as you think about that in your asset allocation framework, I'd probably just kind of put it into that sort of a universe. You could even say the same thing for FX. You don't get a return from being long euros. You get a return from being long euro bonds. You could even say the same thing to some degree for other commodities, crude oil. You only get a return if somebody can turn the crude into something that's worthwhile. So there is a universe of assets that we find in our portfolios that aren't generating dividends or coupons or earnings.
Thanks, James. I was just going to say that there's nothing stopping you holding both. This comes back partly to timing in terms of entry point, which is much more important for cryptocurrency than potentially for other investments, some of the volatility and position sizing. Perfect. I think that is all that we have time for. So if we just pop on to the last slide. If there are any other follow-up questions, things that pop into your mind, please feel free to either contact marketing or your individual relationship managers, and then we can come back to you or set up another call or webinar. So yeah, and if there are any other particular topics, our sort of aim every quarter going forwards is to try and pull in different topics. Although we decided on, I think, crypto before Christmas, it was the movements of the last, I think, week or two that have got quite a few people intrigued further than they have been. And hopefully we've had some of that sort of mystery peeled away by what Paul was talking through. But otherwise, thank you very much for attending this afternoon. We appreciate you logging on, and hopefully you feel like you've understood a little bit more about what we think is going on in the markets and how we're positioned, and look forward to seeing you next month. Thanks. Goodbye, guys.